Hi, everyone. Can everyone hear me okay? All right, we're going to get started. Welcome to How to Hack Angel Investing. My name is Bianca Caban. I lead partnerships at Republic. And we're really excited to be doing this event again with our partner AngelList. I'm going to just go over a few things and then we'll get started. Here's our agenda. What we'll do is spend about 30 to 40 minutes on the content, and then we'll leave plenty of time for questions. So please note that at the bottom of your screen, you should see a Q&A button. Some people have already begun to start asking questions. You can feel free to start asking questions throughout the presentation, and then we'll get to those at the end. And without further ado, I'll introduce our panelists. From AngelList, we have Mike Doherty, General Manager of Fundraising and Investing. And from Republic, we have Caroline Hoffman, Chief Operating Officer. I'll kick it over to Mike to get started.
Thanks, Bianca. Hi, everyone. So as Bianca mentioned, I'm the General Manager of Fundraising and Investing at AngelList. I've been working here for about 6 years, so quite a long history with this industry and angel investing. So to kick this off, I'll start by going over really what is angel investing. So angel investing is a direct investment in a private company. These private companies generally are called startups. Most angel investing does go into technology, high growth technology companies. And really to understand angel investing, you want to understand a little bit about the history of it. Basically, back in the 70s and 80s, when technology angel investing was really starting to take off, it really got its name. And because at the time, if you were starting a company, and you can't go to a traditional source of financing. So if you go to a bank and you have a company that hasn't launched yet, you have no customers, you have no product, it's very, very early. Banks try to look at your history, and they give you a loan potentially based on something like that. This doesn't really work for high growth early stage startup. A good book about this story is actually Shoe Dog by Phil Knight, about the origins of Nike. And you can read through some of his struggles. So these companies ended up actually raising their first capital from individuals who came in and were investing based on their belief in the strength of the team or the strength of the idea, and like trying to actually want to see the thing that the company's doing become real in the world. And so these individuals are investing their personal money. It's not a professional fund manager investing other people's money, et cetera. And they're coming in before other institutional investors might. So that's kind of why they were called angels, like helping these companies get off the ground. These days, angel investing is much more prevalent. It's really become an asset class. So like stocks or bonds, the way you think about the asset class is it's very high risk, potentially high return, but in general, always remember it is very high risk. So when I talk with investors who are thinking about putting a part of their total net worth into this sort of asset class, we generally think about putting around 80% into traditional investments, stocks, bonds, and then they may have around 20% allocated to what they call alternatives, which are higher risk sort of investments and potentially less liquidity, so the money has to get locked up for a longer time. These are things like real estate, like private equity, maybe private debt. And then within there, there's even a smaller section where we say, well, we really don't advise putting more than 2 to 5% of your net worth into this sort of very high risk, long-term holding, potentially high reward asset class called venture capital and angel investing. So you may think, with all that being said, and especially the emphasis on risk, like what makes angel investing interesting? Why would you actually want to angel invest? So on the next slide, we go into this a little bit. But angel investing, really a lot of people do it because it's more interesting. It's very different than putting your money into a brokerage account online, putting a little bit of money into a public stock and then taking it out later. And really nobody knows who you are, and the company's going to exist with or without your capital. When you're angel investing and directly meeting the company, you're putting money behind founders that you believe in. You're really participating in advancing new technologies and creating something out of nothing, like helping create a company that you believe actually should exist in the world. And also, you know, if you have the expertise or the connections or the background to help out the company, a lot of people get a lot of reward in actually being able to actively help the founders they invest in. So so that's kind of the emotional side. We'll talk a bit more about the returns. The other side of this, though, is that it's not something you should do just, you know, just to have fun. It is difficult, and if you're going to do it and try to actually do it well, it's difficult. So so you have to be aware these investments take a very long time to exit. Typical time for companies that IPO in the US has been increasing. So typically it's at least 8 years from founding to IPO or exit these days. Also, startups are very difficult to evaluate. This is why they couldn't raise money from banks, as we were talking about before, because they don't have a product. They may have a product or may not have a product. They may or may not have launched into the market, and so you're really taking a bet on some different signals than you might look at in public investing. And thirdly, the most important thing is actually that these opportunities are difficult to find. You find that that startup founders with the best startup founders with the highest probability of success often have, you know, previous exits, or they have networks. So you find a lot of them like their company's doing really well. They may try first to go to really well-known VCs or to people that they know that have been previous founders and can help them out. Basically, they pick their angel investors. And what you don't want to do is you don't want to be that person who only sees all the companies that that were not able to raise money from anybody else because everyone else said no to them. You actually want to be able to see the companies at the same time, or preferably before anyone else. And so this is what's called deal flow. Building up deal flow is a challenge, takes a long time. But this is actually where platforms like AngelList and Republic come in. So AngelList, I'll talk a little bit about AngelList. AngelList was started in 2010. We have a mission of helping, basically making it easier for founders to start companies. Starting a company is also very difficult undertaking, and it again, for the founder, takes a very long time, and so there's so many challenges you don't actually know how to approach until you actually found a company and realize you're the one who's responsible for everything. So AngelList tries to help founders with 3 main areas. Number one, as we're talking about today, we help founders be able to raise money from angel investors and get started. So part of the founder's responsibility is keeping money in the bank and making sure the company is still alive. So we try to help with that. The second one is when you launch your product, you want to find your first customers. So that's where Product Hunt, which is a brand underneath AngelList, comes in. On Product Hunt, early stage founders can launch new products. They can get feedback and early testers and early users from a community of highly engaged people who are always very interested in what are the new things coming out. And then third, if you have capital and you have customers and everybody likes your product, then you need to hire a team. You need to scale up. You need to get people working to make your vision a reality. And so we also have a platform for technology jobs and recruiting. At this point on AngelList, there are about 2,500 companies who have raised part of their fundraising through AngelList. This comes out to around $880 million in assets under management at this point. So it's a very prevalent platform. And the way we do this is we're very focused on private fundraising and investing for high growth technology companies, and we work with angels that each run what they call a syndicate on top of AngelList, where these angels do have that access. They are the first people to hear about these companies, and then they come to AngelList, and you can invest alongside of them when they invite you. There are 2 companies that have spun out of AngelList that have similar missions and are also helping make the world a better place for founders. So one is Republic and one is CoinList. And so with that, I'll pass this over to Carolyn to talk more about Republic.
Thanks, Mike. And thank you all for joining today. Really excited to see such great attendance. So let me do a quick introduction about Republic. We are a startup investing platform for everyone. And what everyone means is, regardless of your wealth or income, you can invest on Republic. As Mike mentioned, we spun out of AngelList in 2016. Actually, when regulation changed that made investments of individuals, not just accredited investors, but individuals, regardless of their net worth, able to invest in private companies. So how do we do that? There are basically two things to that. One is we set fairly low minimums, and two, we curate deal flow for you. So we bring these angel investment opportunities to you. So on our platform, you can start with as little as $10. It depends by deal. Sometimes it's $50 or $100. And we have both traditional startups as well as blockchain startups. And we do vet startups to be on Republic. So it's not the Wild West. Not everyone who applies can actually raise on Republic. We select between 5 and 10% of applicants to make sure you have curated investable opportunities. And what you'll see is that these opportunities often look a little bit different from the traditional Silicon Valley startups. So we have a slightly more diverse founder set with, in the last year, we had 50% female founders, for example. We have more minority founders, and we have more businesses that are not from Silicon Valley or from New York City, and that's something that's important to us. All in all, what we're doing is really democratizing angel investing. So we're trying to bring this new asset class to you, to everyone, not just wealthy investors. And we are also trying to democratize the fundraising landscape by making it possible for startups that are everywhere in the US, if they have a great idea, to actually stand a chance of raising this initial capital. So what do you need to actually be a great angel investor? I'm going to talk in the next couple of minutes about what it takes, what great angel investing looks like, and we'll dive a little bit more deeply into the part around truly assessing an opportunity. So you basically need three things to be a great angel investor. The first one is deal flow and access. Naval Ravikant, founder of AngelList, said you need a ratio of 100 to 1 opportunities to investment. So that seems like a lot, and that's definitely something that was true when platforms that curated deal flow didn't exist. But there's certainly an important point around seeing a lot of opportunities, analyzing them before making an initial investment. The second one is time commitment to capital. You definitely need time to assess all the opportunities, but we also need capital. Traditionally, angel investment was always in the realm of $25,000 and more. Platforms like AngelList and Republic drastically reduced those capital requirements. In the case of AngelList, it's somewhere around $1,000 to $10,000, and for Republic, it can be as low as $10. And then, as I mentioned before, we'll talk a little bit more in detail about judgment, which is really getting into the nitty-gritty of assessing an individual opportunity. And we have structured this around the 4 T's to simplify it: team, traction, tech, and terms. So let me continue and actually talk a little bit about an example angel investment. So when we think about angel investing and all those deals that would have been great to get into, we think about Uber, Google, Facebook, Snapchat, etc. These are obviously exceptional investment opportunities, or were exceptional investment opportunities if you got in early. And in full disclosure, we took your Facebook as an example because everyone can relate to it, but Facebook never raised on AngelList or Republic, and we actually weren't around when Facebook raised its first couple of funding rounds. But what you can see here is if you invested $100 very early on in their seed round, which they raised at a $5 million valuation, and they raised about $500,000 in 2004, it actually took 8 years to their IPO, and they IPO'd at a valuation of 83 billion. But if you invested $100 in their seed round, your return would have been 3,500x or $350,000. So that's obviously an exceptional investment opportunity, and Facebook is definitely an exceptional case. But what we're trying to show is when you're building an angel investment portfolio, it is about spreading investments across this number of investments, because one or two of these investments will have huge payoffs and will offset multiple other investments that you have made. So if you invested $100 in Facebook, you could have made 1,000 other investments that went to zero, and you would have still seen a return. And I think this is the important message to get here. Not that every angel investment will return 3,500x. That just is not realistic. We wish, but we haven't found that yet. The other thing I think that is important to remember is the typical IPO timeframe is 5 to 7 years. It's getting longer these days. And in the case of Facebook, it took 8 years. So it is an illiquid investment for the time period of that investment. And that's definitely something to bear in mind. So this is not just money you can take out of that startup fairly easily. So now let's look a little bit into the 4 T's. As I mentioned before, this is all about assessing an individual opportunity. It's about team, traction, technology, and terms. I will talk about team, and we have also examples for each of those T's to bring it to life a little bit. And then Mike will dive deeper into traction, technology, and terms. So when we look at team, we actually look for 3 different things. The first one is expertise and execution. The second one is passion. And the third one is vision. Expertise is actually, of the those 3, probably the easiest to assess, because you're looking for hard skills. Does the founder actually have the education, the professional track record, the market understanding that makes this founder really well positioned to solve this particular problem? And there you can look at facts. You can probably ask an expert of that industry to do a little bit of an assessment. The second one is important and is absolutely critical, and is passion. This is about the founder being passionate about the problem that they are solving. And this is really critical, because without passion, the founder won't be able to convince people to follow them, won't be able to sell what they're building really easily, and they won't have the resilience it takes to build a business from the ground up. So you will really want to look for indications of true passion of the founder. And the third is vision. This is about not just being focused on the product 1.0 or the service 1.0 that this team and company is building. It is about being able to draw a real arch of how this product will become a much bigger ecosystem, how there is a product 2.0 and 3.0, and how this founder will evolve the company to grow and really take a much bigger place in the market. So you're really looking for someone who has the foresight and the vision to build their company beyond a single thing. I want to bring this to life a little bit with a company that recently raised on Republic. So Arena is, very simply put, for those who have never used it, a little bit of Pinterest meets Trello, and this is how I simplify it for myself. I'm sure the founders would cringe at it, but it is a pretty cool tool, especially for creatives, so the creative industry. When you look at the founders, you look, wow, 5 founders. That's, in some cases, that can be a little bit of a red flag, but in this case, all of the founders were bringing unique subject matter expertise together. So you had an engineer, you had designers, you have marketing expertise, and all of them and different combinations of them had worked together before. The second thing that we saw is they were really passionate. And how could we see that? When we talked to them, we actually found out this company was born out of a passion project. They were solving this in the off hours from their jobs on the weekends because they felt really strongly that they needed to build this company. This was a problem that they were solving for themselves. And the third was vision. While they were building something that was really solving a problem for them, they had really figured out and were able to draw a fairly elaborate roadmap of how this tool would become something highly useful for the knowledge economy more broadly beyond just creatives. And they had this vision built out, the roadmap built out in order to grow their user base and build and continue to evolve the product. So the team was truly unique, and they did actually a great job raising on our platform, and they were truly solving a need, but they were uniquely combining expertise, passion, and vision in this company that they were building. So that's it about team. I hope it's helpful, and I'm now going to hand it over back to Mike, who will talk about the remaining 3 Ts. Mike, you're on mute still. Yep.
Thank you. Thank you. Great. So the next T is traction. And so when we talk about traction, this talks about the response, basically, how many users, how many customers, et cetera, that a startup has had. What's their actual progress that they've been made. And we did talk earlier about how startups at the very earliest stage have not made nearly as much progress as a public company. At this point, if you invest in Facebook, you see that they have billions of users. And if you look at an early stage company, obviously they're not there yet. But it is looking for those first few signs that a startup is getting a positive response, and this is something that people want, and that this team is going to be able to make the progress that they say that they want to make in their vision. So within traction, it depends a bit on the type of company and the market that they're and their business model that you're looking at. So if you look at consumer companies, for example, consumer companies are often about how many users are there, how engaged are those users, how viral is this product, and are those users inviting future other users. A lot of consumer products become more valuable as they engage more users. So this is called network effects. So the types of numbers you look at, you're looking at how many monthly active users are there, what's their retention rate, how do users use it for a week and drop off, etc. What's their cost of customer acquisition? Is it going to be prohibitively expensive for them to grow, or do they have a high viral coefficient where for every user they bring on, that user recommends their product to 1 or 2 other users, this sort of thing. Enterprise companies at the earliest stage, you're looking for a slightly different approach. Enterprise companies often are about sales. They're about they're about actually providing value to other companies. And the way one of the ways I measure this actually is whether other companies are already paying them for what they're doing. Their product obviously isn't as developed as a large company, but they should have identified a real problem. And before a seed stage investment for an enterprise company, I'm often looking for somewhere between 2 and 10 paying customers. And the customers are when they're paying, it proves to me that there's something valuable enough here that another company believes by paying this amount of money, their business will do better. And so, and it also shows to me that the team knows how to sell and is able to actually make sales, because building up a sales force and or a marketing plan, and knowing how to convert people from saying, "No, this is nice, I'd like to try it out," to paying for something is a hugely important skill for an enterprise company. Over time, as they develop their traction and get more customers, then you start looking at the annual recurring revenue. You look at the churn rate, which is how often do users drop off, versus renewal rate, versus for each customer, what's the average customer value, et cetera. The third type of company that you'll see pretty often in early stage technology investing is companies that are really focused on deep tech. And what I mean by this is things that are more research oriented. Medical startups are often kind of in this stage. Biotech, you see it sometimes if you were to look at SpaceX, for example, in the space tech industry many years ago, you'd also see that they're in this area. And for these companies, the biggest risk is actually often are they actually able to build what they want to build? And so you'll find that in the first few rounds of funding for a lot of these companies, they're more what you call milestone based. Like if they do X tests on their and X research, do they prove that it's starting to work? And can they raise more money to do the next stage of research? These companies are very difficult to assess unless you're an actual expert in their particular vertical and particular industry. So we're not going to focus on these companies very much through the rest of the presentation, but do know if you see something like this and you're looking at a kind of milestone-based fundraising, question your judgment if you're not an expert as well in that area, and can really evaluate yourself whether it seems like this technology and this product is going to work. So anyway, with that said, let's move on to the example for Traction. And in this case, the example is a company called Roomi. Roomi helps individuals who are apartment hunting match with roommates. So this is a pretty big problem, especially as more and more people, young people in particular, are renting these days and living in cities, etc. So Roomi raised money a few times because it's been now a couple of years and they've been growing. They were on AngelList in June 2015 for the first time, and then they also ended up raising around on Republic in 2018. So both platforms were able to invest on Roomi. When they came through AngelList, as I mentioned, AngelList has angels who are sponsoring each deal and investing themselves. So this one came through Cyan Bannister. And when they were on AngelList, they had 10,000 monthly active users. They had 55,000 users, which was a good data point for a seed stage investment. Over time, as they grew, we noticed by 2016 they'd grown their user base by 18x. So sometimes you're looking at points and you're saying, does this company have a reasonable number of users now, and do they have some theory about how they'll get future users? That's often at the very early stages, but over time you actually get a track record of do these founders execute and actually grow their user base. So for this one, by the time they got on Republic, they had a few more years of history and they'd seen that they were growing. So that was one. That's kind of an example of looking at traction for a very early company and also looking at traction for a company that's a few years old. The next T I'd like to talk about is technology, and by technology, we're talking about not just their actual code and algorithms and stuff, but really also the product. What is it that they're building? So with this, with this we break it down into a couple of sections as well. And this is not complete, but these are some ways to start as you develop your sense for how to look at technology and product. Number one, look at the problem that they're solving and whether it's worth solving, and then look at the solution, and is this team able to build the solution that will solve the problem? Does their solution actually solve the problem for people? And you can go down into their product roadmap or their previous releases and how they've developed. Another good thing to look at here is the feedback that they're getting from as they launch the product and they get user feedback and stuff. Does the team continue evolving their product and making it better and better for their users? So then this goes in also into user experience. And sometimes, especially with consumer products where maybe you are a target user, you can directly evaluate the product. Other times you may have to actually look at the traction and see, do the target users actually find this product solves their problems? For me, my rule of thumb is I look at, do I feel this product is 10x better than the alternatives? I've always found it's very difficult to convince someone who has a certain way of doing something, a customer is already like doing this in their life. If you want to convince them to switch, it's very hard for a 10% improvement, 20% improvement. But if your product really is totally unambiguously 10x better than their alternatives, either cheaper or more efficient or just more fun, and then it's pretty easy to get people to switch, and you'll find that this company is able to onboard users pretty fast. So finally, as you're evaluating the product and the technology, you should start to look at, you should also look at competition. Make sure you understand the space that they're entering. Is it a very crowded space? Is this team and this product, do they actually stand out? So again, it's kind of coming back to that 10x better thing, but more formally, like looking at the competition. An example for this type of for this tea is a company called uBiome. uBiome was on AngelList in June 2014, and at the time they were the first, really the first company focused on analyzing your microbiome at home and making pretty easy to do. And microbiome has been an area of research for a while. There's a lot of evidence that the bacteria that live in your intestines and your stomach, etc., especially the balance between them, can have a big effect on your health, and not just digestive health, but even as far as your mental and emotional health. So this has been a huge area of research. And when we looked at this company, even when it was very early on, it didn't have a lot of customers, we could tell that their solution was pretty innovative. They brought in not just the biology background from the founders that have PhDs and stuff, but they've proven that their customer base at Harvard, Stanford, UCSF, et cetera, are also experts and are also trusting them. And then they bring in the big data approach. They made the user experience much better than going to see your doctor, going to see a lab, et cetera, waiting around, but you're able to do it yourself pretty quickly at home. And so it was evident that this product was innovative and entering a very interesting growing market. And today they've continued to grow. And today they definitely have the largest database of genetic information about microbiomes probably in the world. I'm not 100% certain about that, but it's a very large database of microbiome information. And so they're able to do research that other people are not able to do. And so this continues to build a technology moat around this company. And so that's a pretty exciting one. And we were able to look at them early and then also continue looking as they develop over time, which you'll find is a trend among all of these ways of evaluating startups. So the final T is terms, and this refers to really the legal terms in your agreement. And you should be familiar with these, but the legal terms in the agreement can never make an investment great. Only the company actually doing well, onboarding customers, become a big success, makes an investment great. But the legal terms are something you should watch out for, because they can ruin an investment if they're not standard and there's something in there you didn't understand. So at the very top level, and again, this is a pretty detailed topic, so we'll just go over some basic terms, the most important ones that you should be watching out for. But you should definitely do some more research yourself here and make sure you understand what you're investing in. But at the top level, companies at the seed stage have two ways that they raise money. Primarily, number one, they sell equity. This is the most standard, and it means that they're issuing new stock. So you're actually buying a share in a company, similar to you might buy a share in a public company. You own a piece of the company. In private companies, they typically sell what are called preferred shares, which have some additional rights over and above common shares, which are the basic units of ownership within a company. And when you hear a term saying Series A, Series B, Series C, The word series comes because it's that's the name of that class of preferred shares. These are the Series A preferred shares, and then maybe there's a Series B preferred shares, etc. This is where terms come in. And there are more terms than in public investing because your money is stuck with the company for a long time. And so you also want some additional rights. We'll go into that a bit more later. But the other option is that companies can, at the earliest stage, in order to make it, to simplify for them how they're raising money and make it easier to get started, is they can actually issue a legal agreement that allows you to put in some money now, and then when they actually do issue their next series of preferred shares, to convert your investment now into those shares. So those two, the main types of agreements you'll see for that are, number one, a SAFE. A SAFE stands for a simple agreement for future equity. So it's basically right there in its name. This is an agreement you're buying that converts into equity in the future. This was created from Y Combinator, one of the top accelerators in the world, a number of years ago. And on AngelList, we actually see about 40% of seed stage companies these days are raising money on SAFEs. There's a version of a SAFE called a crowd SAFE that's designed to work with regulation, crowdfunding, and that Republic has created. It's basically the same thing, but it's optimized to make it easy for companies to work with Republic and accept investment from a large number of investors. And then finally, there's convertible notes. And convertible notes operate very similarly. The convertible half of the name means that, again, this note converts into equity in the future. And then the reason it's called a note is because the underlying structure of it is it's structured as a loan to the company. So that means it has an interest rate and a maturity date. These are convertible notes have been around much longer than SAFEs. So right now we see about 20% of seed stage technology companies are using convertible notes when they raise money, raise their first round of funding, I should say. And the convertible note, really the goal in a high growth technology company is to see the company either take off like crazy or to go to zero. So in the best case, you actually do convert your note into equity. In the worst case, you write it off and it goes to zero. So investors and founders found that the interest rate, the maturity date, et cetera, was really very rarely came into play and was never really the determinant between was this a great investment or a bad investment. And that's why a lot of companies have switched over to the SAFE now that they have SAFEs. Finally, I'll just go through three terms on the common term side. So valuation is similar to market cap for a public company. This is the overall, how much is the company worth? So if you buy one share in a company, let's say it has 10 shares and it's worth, and the valuation is $10 million, that one share is worth 1/10 of the company or $1 million. Obviously, most companies have more than 10 shares, but that's what valuation means. And so you hear that term a lot when you see announcements of companies raising money. The valuation cap and then discount are terms that you see on SAFEs and convertible notes, and these affect what the valuation is when that SAFE or that note actually turns into equity. So the valuation cap is the maximum value at which your SAFE would convert into equity. So if you invest on a $5 million cap and the company raises its next round of funding and issues a series of shares at a $10 million cap, your investment comes in as if you had invested at a $5 million valuation. You get that percentage of the company. So in practice, for companies that are growing, valuation and valuation cap are typically treated pretty similarly, because if the company does do really well, then their next round of funding should be 2 to 3x higher valuation than whatever they were raising at originally. So, but if they don't, and if they say you invested a $5 million cap and then their next round is at a $4 million valuation and they issue equity there, then your discount comes into play. And the discount is saying, even in this case where things didn't work out perfectly and the valuation we raised at didn't increase very much, you still invested earlier than our investors. You took on more risk. So your SAFE, your convertible note, may convert at a 20% discount to what the final valuation ends up being. And And 20% is pretty normal. I've seen them up to 40 or 50%, and I've also seen a fair amount that have a 0% discount. But typically you'll see around 20%. And then finally, dilution pro rata rights are something that you should be aware of. Dilution happens naturally as companies scale up. Since it takes quite a long time to get to IPO and to exit, and you're growing a company very fast, you may end up raising more capital. And so at each round, on average, most companies are issuing around 20% more stock. This means that your ownership percentage of the company, even if the value is increasing, the percentage you own may decrease by around 20% or so for each round, depending on how much capital the company raises. And so if you go all the way back to the Facebook example, you see that Caroline talked about a 3,500x return on an initial seed round investment into Facebook. But then if you actually looked at the valuation of Facebook between those two spots, you saw that increased by 15,000x. That's basically the difference between that is basically the result of dilution over multiple rounds of funding. Pro rata rights, just very briefly, give you the right to continue investing in future rounds to maintain your ownership. So in each future round, as new funding is raised, you may be able to invest and buy another 20% of, you may be able to buy a portion of that new round that the company is issuing. Your price will be higher, but at the same time, this is actually where a lot of the larger institutional investors that save money to continue investing in the companies that are taking off and the winners in their portfolio, this is actually where they make a lot of money. So pro rata rights are something to really think about if you believe this company is the one that's going to do really well. So so again, you can go as deep as you want into terms, but I'm going to pass this back to Carolyn to talk a little bit about next steps, and then we'll open up for questions.
Great, thanks, Mike. Yes, before I wrap up with the last 3 slides, if you have questions, we've been getting some in throughout, but please feel free to use the Q&A button and type your questions, and we'll go through as many as we can in the next couple of minutes. So the next 3 slides are really just to give you an overview of how to get started. This is a brief overview of our platforms and a little bit of a side-by-side of Republic and AngelList. When you look at investors and what investors we cater to, Republic is really open to everyone, and AngelList takes accredited investors only. Our investment minimums are really low. Anything from $10 to $100 is the typical minimum investment that varies from deal to deal. And AngelList starts at $1,000 to $10,000 by deal. The deal flow, we do curate our deal flow. As I mentioned, we select between 5 and 10% of companies that apply. For AngelList, it works a little bit differently with a syndicate lead that is an experienced angel investor that brings an opportunity typically to AngelList to fundraise on AngelList, but the round on AngelList is typically led by a syndicate lead. Our typical deal stage is anything between seed and Series A, and AngelList does have the same plus a couple of later stage deals as well into Series B and beyond. And then very simply, republic.co or angel.co if you want to find out more. Now, a couple of more really tactical tips. Set aside an annual budget and don't set aside more than you can afford to lose. Sign up for multiple platforms. I think the point, despite platforms really doing a pre-selection and curation, I think it's really important that you see a lot of deals and explore and read. Engage with the founders on Republic. You can easily message them and engage with the syndicate leads and ask them about their approach to investing and why they selected that deal. I'm definitely biased, and Mike maybe too, but there's no better way to learn about startups than working at one. So if you're in the market, Angel AngelList has a great job posting functionality, and it's probably the biggest listing of startup jobs out there, but there's probably no better way to learn about startups than actually to see one from the inside, or two or three, and read about tech and startups. We have a long list here on the next page of recommended readings and sources that we go to, and we also published a blog post on republic.co/blog a couple of weeks ago about interesting startup readings to learn more. So with that, I would like to thank everyone for attending our Q&A session and start with a our webinar and start with a Q&A session. I think I can start with one question that I saw, which was someone asked earlier, if I am basically courted by high-profile VCs, why would I raise on Republic? So this is more of a question for a founder, or for founders who may be on and thinking about this, rather than for investors. But the reason is really that if you bring an opportunity, if you bring your company to fundraise on Republic, it is about much more than collecting a couple of checks. First, you can collect checks from a much broader audience, our investor base and also your investor base, and they don't have to be accredited investors. There's a huge and there's a value add to that, and you can run an extended friends and family round that way. The second part is you will get 100, 500, 1,000 investors through a successful campaign on Republic, but these people are not just your investors, they are your fans, they're loyal customers often, and they will talk about you, your company, and why this is a great investment that they made. Because at the end of the day, no one ever asks, oh, how much have you invested in that company, when you say, I'm an investor in X. But you will very readily and credibly talk about this. And so think about a round like this as well as a round where you can have 1,000 brand ambassadors running around the US and elsewhere in the world and advocating for your company, because your interests are aligned with your investors and they want you to be successful to generate a return, and they are just proud investors, and we see that all the time.
Great. I saw a few questions about international, both on the company side. Are there international companies raising money on AngelList and Republic? And on the investor side, are international investors able to invest through AngelList and Republic? So speaking for AngelList, the answer is yes to both. We do allow investors from international countries to invest through AngelList. We have teams and we are legal in Canada, the EU, UK, and India for companies to raise money. But even outside those areas, investors in other areas can invest through AngelList into companies in those regions. We see, I don't have the exact number off the top of my head, but we see 20 to 30% of capital coming from international investors on AngelList. It's actually, these platforms are actually pretty useful for international investors, because you aren't in Silicon Valley, you aren't in New York, you aren't necessarily even in the US and like seeing these deal flow sources, because you are based somewhere else. And so going back to that deal flow and access question, both Republic and AngelList are pretty good ways to start to be able to see deal flow from a region where you are not. And likewise, the company side of it, companies in international regions are able to use AngelList to raise capital. What we found works really well is, because AngelList, we're working through these angels we call syndicate leads. Each of these angels have their different areas of expertise where they're able to source companies, access companies, and do due diligence on companies. So we see a few leads, for example, that have very good access in Canada and almost specialize in companies from Canada. We have a few focused on the Midwest in the US. We have a few in Europe, and we're growing our India presence as well. So So because we're able to work with these angels that we vet, they're able to vouch for the companies that they're investing in locally. I'm actually not sure on Republic if you've had international companies raise money.
We have had international companies raise money, but they do have to have a US subsidiary, which is actually fairly unbureaucratic and easy to set up. And we do also see a similar rate of international investors as you guys do, Mike. We have around 20%, I would say. And we have really people from, I think, about 100 countries in the world that have invested. I can take another question here. I saw something related, which was what type of paperwork is needed to be an investor, and then what type of KYC process we do. Very simply on Republic, the whole process is very unbureaucratic, especially if you stay under specific amounts. All we need is your name, and then you can invest with a credit card. And I think if you're above $1,000, we do require a more sophisticated KYC AML process where you have to send in a picture, or just send in a picture of your ID. We have a third-party provider that handles that. It's a fairly standard process. We always say it takes literally 2-3 minutes to become an angel investor in Republic, and we typically stay true to that. Obviously, you should take a little bit of time to select the right opportunity, but it is a fairly quick process.
I'll answer a few questions as well. So in the order that I saw them, there are 2 questions, I believe, about the discounts on safes and convertible notes. One was about why 20%. I actually don't know if there's a great reason for why, other than that's kind of where the market settled. Founders obviously want it to be as little as possible. Investors want it to be as much as possible, and the market sort of settled on 20%. So in general, a lot of what you're looking for in terms at early stage investing is for them to be standard. You actually don't want to impose a huge legal burden on the companies to have something totally custom that they are watching out for and are constantly going to run into issues with. That adds a lot of overhead to the company, and likewise for the investor side. If you are investing in a broad set of companies and wanting to diversify, as Carolyn was talking about, like you want to know that your companies are your investment in each one won't be gigantic, and you also want to know that that they're all operating pretty similarly. So actually, what I've learned is the biggest thing is to look for standard terms. And the more standard they are, it feels like the easier it may be to work with this founder. Obviously, check with your lawyer if you do have concerns about any particular investment. The second question around this was, when does this discount come into play? Does this come into effect at the next VC funding round, et cetera? That's exactly right. So it comes into effect at the next round. When the note or the safe converts, it changes from being just a debt to being equity. That's actually when the discount comes into play. So if the conversion happens, if the next round happens at or below the valuation cap, the discount comes into play then, so that you still actually have some unrealized return, some benefit for investing earlier via that note or via that safe, versus waiting and investing at the next round. Like I said, though, the ideal case is that the company is taking off like crazy, and so in that case, the valuation ideally is higher or much higher than the valuation cap, and so in that case, the 20% discount does not come into play. So let's see. So the next question was, can I cash out at the next investment round or before, not waiting for an acquisition or IPO? This is extremely rare in early stage in investing. This is really perhaps one of the defining features of venture capital, is that you're giving money to this company to use to try to use that capital to create something new. And so, your money gets locked up basically until the company exits. There are some rare cases, like if the company is doing very, very well, and the next round investors want to put in more money than the company can accept, they may offer what's called a secondary to some of their early investors. But typically, as a small investor in the company, you don't want to, you'd probably rather keep your money invested into the companies that are doing really well because they're continuing to grow. But B, if you go to the company and you're like, I need my money back, and the company's already spending all their money on growth, on engineering, on product, on salespeople, et cetera, because they're trying to create something in the world, by coming in early, you may actually negatively affect the company's progress. And not only does that potentially hurt your relationship with that founder, but like other founders all talk to each other, and you don't want to get a reputation as being an investor that's difficult to work with. So typically you'll just find that investors do stay with the companies until exit. And the psychology of this that I think about is, if I invest some money into a company, I just assume it's gone, and I just assume I can't touch that money again. Maybe I'll get something far in the future, but like, I'm not investing capital that I wouldn't be okay going to zero, because I'm not going to be able to use it for a few years. And so effectively, it's not available to me. Last one I can answer very quickly is, how many co-founders would be a reasonable number in order to not bring up a red flag? What we see is that the typical company has two co-founders. 2 or 3 is pretty normal. 1 can be a red flag. It's not necessarily bad, but it's very tough being a founder. And so having someone else who complements your skills, who really understands what you're going through, et cetera, is actually pretty helpful. And we just find companies with two founders are more commonly able to scale up than companies with 1. And then on the other side, Carolyn mentioned 5 might be starting to get into the red flag territory of like too many cooks in the kitchen sort of thing. And so so the norm that you'll see is 2 to 3. 4 is fine, but if you're getting up to like 10 co-founders or something, it's quite a lot.
Yeah. I can answer a couple of more questions that I saw that were more specific to Republic. By the way, I'm trying, because we focus this about the skills of investing, and it's a webcast that is mostly focused on investors. I have only briefly tackled or not tackled questions that are more founder specific. If you do have questions that relate to Republic and are about being a founder who is considering raising on Republic or AngelList, just email me at caroline@republic.co, and I'll manage fielding you to the right person or getting you the right answer back. So one question I saw from Sue was, yes, we do have slightly different deal flow on Republic. We have slightly different deals and what the verticals are. So I would say Silicon Valley typically takes a fairly hard look and says, tech is tech, and it really needs to be driven by tech in order to be a tech company. I think we look at it as we are also open to e-commerce, for example, right? It's rare to find a company that has absolutely nothing to do with the internet these days, but we do look at tech-enabled versus just pure and hardcore tech companies. We also have had a Prosecco company raise, and we are in the process of onboarding a couple of more companies in the space. So we don't look at tech with exactly the same lens as I would say the typical Silicon Valley VC does, because we think that there are lots of good investable opportunities out there. And by the way, not all of them may necessarily be with a safe or convertible note. Some of them may be revenue share opportunities or venture debt opportunities. So that's definitely something to bear in mind. I think we're almost at the hour. Yeah, we're already 2 minutes over. Let definitely, if you have questions that have remained unanswered, we'll make sure to answer all the pressing questions. Feel free to email me at caroline@republic.co. And Thank you very much to all of you for attending. We really appreciate it. And we hope that this was helpful to you. And now off to happy and interesting investing, hopefully.
Thank you, everyone. I'm Mike at angel.co. Like Carolyn said, I really appreciate you taking an hour, and I hope this was very helpful.
Bye.